Hi folks, welcome to the Better Dwelling YouTube channel. I'm Daniel TENCER and I'm here today with Ron Butler, founder of Butler Mortgage and a pretty prominent figure in the real estate social media environment in Canada. Ron has come here to talk today about the mortgage market and inflation. Now, we've got a bit more inflation than we used to these days in Canada's economy and all across the developed world, actually. The latest numbers from StatsCan for August had the consumer price index at 4.1%. That's the highest level since 2003. And one of the measures of core inflation, the underlying inflation trends in our economy, is actually running at its hottest in 30 years. So it looks like we might have a bit more inflation going forward than we had in the past, and that could have real consequences for the mortgage market. So thanks, Ron, for taking the time to talk to me today. And let's begin here. Do you think the Bank of Canada is going to be under pressure to raise interest rates sooner than you expect, or sooner than they are advertising they will, because of this inflation run?
Well, they change their minds on a fairly regular basis, but it's unlikely we'll see any change this year. Very unlikely, virtually impossible. Will there be a change next year? Will there be an increase in prime rate for the Bank of Canada next year? Possible. But if the change happens on the last available date in 2022, then it's really more of a 2023 story. Certainly, they are not indicating they have any intention of raising rates in the near term, which would take up most of 2022. Now, inflation, obviously, anyone who eats in Canada knows there's inflation. Whether you go to a restaurant or whether you're buying groceries, it's very obvious there's inflation. It's unavoidable.
Right.
So, how does it factor into their thinking at the Bank of Canada? Although they claim to be non-political, it's obviously not true. They are influenced by government thinking. They're influenced by their observation of the sectors that they work in and that they observe. And it's just not likely they're going to do anything until the very end of 2022. That's just kind of a universal thought they've proclaimed over and over again. We got to remember back when the COVID crisis started, they were very emphatic about 2023 being their year. So personally, based on long years of watching the Bank of Canada, particularly under this governor and the previous governor, I don't necessarily see that there will be an increase for the next 12 months.
So they sort of staked out their position. We're not moving at least until the end of 2022. We're at least a year away from the nearest move. And you don't see much of anything changing that. Okay, fair enough. But right now we've got mortgage rates at what, 1.5, 1.8%?
And not anymore. If we're talking about 5-year fixed rates, that's really gone into the 2%, the very low 2s, very high 1.9s. That's where it's graduated to.
Okay, so they've pushed up a little bit to 1.9, 2.1, 2.2.
Variable, which is based on the Bank of Canada Prime, is still remarkably low. We can place very large mortgages, like over $1 million, for a net rate of 1.1, sometimes 1.05, often 1.15. So that is a spectacularly low rate.
Yeah, that is a huge discount over the fixed rates right now that those variable rate mortgages are showing. But either way, the variable rate or the fixed rates right now are below consumer inflation, which is running at around 4%. So you've got a negative real mortgage rate. You're actually paying less in interest than that money would be losing in value just to inflation. So I can't think of a better situation for mortgage borrowers than that, where you don't even have to cover the inflation on the money you borrow. So to me, it seems like that must have something to do with the hot prices we're seeing this year and coming out of the pandemic. Do you agree that these things are related?
There's no question that low mortgage rates are the fuel for high home prices and for accelerating home prices. They're not necessarily the ignition. They're not necessarily the sole impact, but they're a very major force, no question.
And so, do you see any scenario where the Bank of Canada would actually react to that? Or are they happy to leave mortgage rates negative for a year or more at this point?
That's a good question. I mean, I think one of the most important things to understand is that the Bank of Canada is not the sole arbitrator of how mortgages work in Canada. Sure, they affect the interest rate, but the Department of Finance, through its bank regulator, OSFI, the Office of the Superintendent of Financial Institutions, can initiate mortgage rule changes on a dime that would radically change the approach to lending in this country for mortgages. And that's another tool that the government can use, a kind of a surreptitious tool, because the government of the day is allowed to say it's a regulator who's made these changes. They're independent. They make up their own mind.
Right.
And that regulator could conceivably make changes before the end of this year that would affect the ability of Canadians to get the mortgages they want or they desire. You notice I didn't use the word need, but
Right.
So there's other tools that can be used, and the Bank of Canada recognizes this, that would reduce some of the heat in mortgage world, and therefore reduce some of the heat on real estate prices.
It sounds like you're talking about the mortgage stress test, the qualifying rate that you have to match to get an insured mortgage. Is that what you're referring to? Are you seeing maybe potentially another hike in the mortgage stress test?
No, it's possible, but it's unlikely. If you look around the world, jurisdictions like New Zealand, and by the way, I'm not one of those people who think New Zealand is the same as Canada. That's ridiculous. It's not. But in some countries, in English-speaking countries, they have changed mortgage rules to radically impact the ability of investors to get mortgages. That has radically impacted the ability for people to own more than one house. And those kind of rule changes I'm not predicting, but I'm just saying there is a huge toolbox of rule changes the bank regulators can apply, because the bank regulator also controls the mortgage insurers, the people who insure mortgages with less than 20% down. So they have a wide range of abilities to impact on mortgage lending in Canada, and mortgage lending, a radical change in mortgage lending in Canada would no doubt have a radical effect on house prices.
Right. You've been tweeting a lot lately about, I believe it was, people with multiple mortgages, but you focused in recent tweets on people with 4 or more mortgages. And there's been a large spike, apparently, in the number of people with their 4th mortgage. It's rising faster than the number of people who are getting their first mortgage, first-time home buyers. Yes. What is that telling you about the housing market right now? It seems to be like maybe some people are getting priced out to the benefit of investor owners.
Well, in the case of these mortgages, where it needs to be a little clearer understanding, what this stat is talking about is the 4th mortgage that is appearing on a credit bureau. That was the originator of the information, was the Equifax system. So they're suggesting that they have seen more fourth mortgages. In other words, 1, 2, 3, 4 mortgages appearing on a credit bureau than they have in any time in the past. However, these are not necessarily the same mortgages on the same house. In fact, they're almost certainly are not. They are mortgages on multiple properties, or they're an existing mortgage, then a line of credit on an existing property to allow the purchase of another property, performing the down payment, and creating the purchase of another property. So it is a function of a trend we've seen a lot of in the last 12 months, which is when people choose to buy their move up home, when people feel that their incomes have grown and their family situation has reached a point where they need a bigger house, or a house in a better location, or a house in a different location, that they're more likely to retain their existing home as a rental property by refinancing that home, taking out a line of credit, taking out another mortgage, using that as the down payment, and then moving up to the new, bigger, better property. Historically, this is something that rarely happened. If we go back 10, 15 years, it was an anomaly. Today, it's probably 15 to 20% of all situations we come across. Now, that's something that didn't exist 5 years ago to any great degree.
Sounds like there's been a kind of a change in culture here, that people's attitudes towards the housing market have changed, essentially. That we used to think of housing primarily as a place to live. If you pay off your mortgage, you don't have a monthly liability to anyone. It's a way of getting financial security. But now the attitude seems to have shifted for everyone to being one of, you should just hold on to all the real estate you can because it'll keep going up in value. You were tweeting recently about, I can't remember the term you used, the always up culture, or the infinite up culture.
The infinite up concept of real estate. What's important to grasp is that if you're a 50-year-old in Ontario, 50-year-old is not a young person, but if you're a 50-year-old in Ontario, you have no personal experience of real estate ever actually going down. I mean, there's been occasional blips. There's been 2017, in some parts of Toronto, there was a drop of, say, 15% of value, and then it recovered within 14 months, 15 months, which means if something recovered in a year, you wouldn't even notice. I mean, there was a drop in real estate values all across Canada in 2008 in response to the world financial crisis, probably about 15%. It was fully recovered in 14, 15 months. So in reality, how are you going to know that something actually happened? You didn't move. You weren't forced to move. You had no requirement to move in those short periods where the dip occurred. So for you, nothing happened. Just a few people who may have been transferred in their job or upset by a marital breakdown had to sell in those specific narrow periods of time. And they may have said, wow, I've taken a bit of a beating here. Or perhaps people in the energy, in Calgary, in the energy industry, who, those house prices took a severe dip in southern Alberta, parts of Alberta, mainly in some cases recovered now. But it's just been situational. There's been no long-term disaster such in property values, such as occurred in Ontario in 1990, when prices of single-family dwellings dropped on average 26%, and they stayed down for 5 years. So when something stays down for 5 years in the real estate business, there's a lot of people who had to move, had to sell, had to do something, and noticed that if they'd bought previous to 1990, they took a beating. And a lot of people noticed. And at that point, it becomes culturally accepted. But if you're 50 years old in Ontario, chances are you have a lived experience that real estate only goes up in value. And why would you suspect that would change? Like, what would lead you to think it would change? Because guess what? We just went through a 100-year pandemic, unheard of economic disaster. And the end result of it was that real estate went up faster in value. Right. So if you were confronted by these facts, hey, this is the worst thing that could have happened in 100 years, and all that happened in Canada is the values went up. You know what? They'll never go down. If you were somebody who wanted to analyze 100-year history of real estate or expand your analysis into other countries, you would realize that's probably not true. But if you're a normal human being who is not in the real estate business and you're 50 years old, your entire belief structure would be that real estate always goes up. And there's frankly not a lot of reason to think that you're not right.
Well, yeah, fair enough, especially if what we've seen is recent history. What is your take on this attitude? On the one hand, the people who buy into this infinite up, this always up, house prices always go up narrative, have been proven right. On the other hand, it seems like it's accelerating and intensifying people's behavior. Now you've got almost everybody holding on to every house they buy. Instead of upgrading, you just become a landlord right away. You keep the property you have. Well, not everybody can become a landlord. Somebody has to be a tenant after all. So what's your take on this? Has this gone too far? Is the infinite up logic coming to a kind of a mathematical end, or do you think this can go on?
If we're going to import 400,000 new Canadians a year, then there's a chance you're still right for a while. This is what people in our industry and people in social media who watch this phenomenon have ended up. This is where we're at, that we can no longer explain this. I mean, it is not entirely rational. It's not normal within the history of real estate. Real estate traditionally, if has greatly expanded, and in some cities in Canada, I think we can say that in Lindsay, Ontario, or in Sudbury, the price of homes has gone up 40% in 1 year. Now, there's no natural way that could ever occur. It's very abnormal, and yet there's no panic. There's no over concern. It's not front page news. There's sort of a general trepidation in some small areas, like guys like me. But no, it's not. It's not an opinion that's greatly regarded. So at this point, if you're me, who's been wrong for so long about the possibility of prices going down, you just have to shut up and point out that it's unusual. Like, it's just plain unusual. And as to your point, I think it's valid. It's a cultural change. It's a societal, systemic change in attitudes about real estate and about homes in general. And will it turn out to be a benefit to our society? I frankly doubt it, because the idea that a 2,600 square foot 2-story in North Ajax should be worth $4 million in 6 years is kind of a ridiculous thought, but that is actually the trend line if we follow it. So right. It can't be good for people of less than middle incomes, because eventually it's got to translate into rents. It just has to. So does it exacerbate income inequality? Does it exacerbate wealth inequality? You'd have to say yes. You'd have to say that it does. Where is the end point? I don't know.
Yeah, maybe nobody really knows that at this point. One last question I'd like to ask you. What advice would you give to somebody who's getting into the market today, or like me, is about to renew a mortgage? What would you say in terms of go variable versus fixed, long-term, short-term, do it, don't do it? What's your advice there?
Well, it's hard for me to say don't do it, because for the last 10 years, I have been relentlessly wrong about the direction of real estate prices. They've just gone up. So I have to, at best, all I can do is remain silent on that issue. As for the other consideration is that if you're just getting in, real estate purchase is not strictly an investment decision. If you've just had twin babies, and you need to get into bigger premises, it's not just an investment thought process. It's also about how your life is going to be lived. And again, I can't comment on those pressures. It's not reasonable. Now, on renewal, it's much easier to make a comment. If you have any sort of risk tolerance today, take a variable rate. You can always switch relatively effortlessly into a fixed rate later if you're pressed to do so. And with about 105 to 110 basis points of spread, it's difficult to say that you shouldn't, if you have any risk tolerance, try the variable rate. But do shop. Don't take your bank's first offer. Don't take your lender's first offer. Study the market. There's rate sites galore in every city that talk about mortgage rates. Do your investigation, do your due diligence, find a great deal.
In other words, maybe have a little bit of that old-timey attitude that people used to have, that a house is a place to live and you should be able to afford it. A bit of that, maybe?
Bit of that. People like me are being put into a corner. I mean, it's become so unfashionable. We've been wrong for so long. It's tough to say, but I do acknowledge, and I always do, that buying a home is not just an investment decision. You also have to have a place that you're happy to wake up in every morning. I mean, that's just the reality. But on the renewal side, it's a great moment in time. If you already have a mortgage and you want to renew, if you take a variable rate at 1.15, 1.10%, even 1.2, nearly 70% of every dime you pay goes to principal. So you are doing a tremendous job of knocking down your mortgage, and that rate might be around for another year or two. So no guarantees, but it would be a great experience to see your mortgage drop as fast as good.
Yeah, well, that's a very good point to highlight about low mortgage rates, and a good place to leave it as well. So, Ron, thanks very much for taking the time to talk with me today. I really appreciate it. I think we got some good insights into what's going on in the mortgage market today, even if there aren't any 100% answers about what the future holds. So
there are not. Great talking to you. Thanks for your time, and thanks for inviting me.
Thank you. Take care. And if you enjoyed this video, please hit the subscribe button. Please hit the like button below so that YouTube will share us with a larger group of people. Thanks very much. Take care. Bye-bye.